Hi, I'm Richard Vague. Today we're going to talk briefly about the Federal Reserve. There's a lot of mythology around the Fed, but at bottom it is just a bank, although one that is an agency of the federal government. It's a bank with a couple of very special dispensations, however. First, it can require that other banks leave deposits with it that pay low or no interest, though it calls those deposits reserves instead of deposits. Second, it doesn't really have to have much in the way of capital, while other banks are generally required to have around 10% or more capital to assets. So it doesn't quite have the same requirement to earn money, though it in fact does and funnels those earnings off to the Treasury. Who does the Federal Reserve lend money to? Well, primarily the U.S. government by owning government bonds. And the modern banking industry essentially got its start by lending money to governments, with the Bank of England established in 1696 to lend to the British government, and the Bank of North America and the Bank of the United States, established in 1781 and 1791 respectively, to do the same. Since the Fed is a bank, who does it lend to? The Fed currently owns $5.1 trillion in government bonds, which means it has loaned the U.S. Treasury that much, and $2.3 trillion in mortgage bonds, which means it has loaned homeowners that much. It also makes a few much smaller loans. For example, in times of global economic duress, it has loaned dollars to other central banks in exchange for an equal amount of their currency to meet the temporary extraordinary needs of banks in those regions in those circumstances. These loans are called swaps, and here we see the Federal Reserve swaps in ratio to GDP over the last 60 years and how episodic those loans are since they relate to crises. While the Federal Reserve is larger than the other central banks in the world on a currency exchange basis, namely the Bank of Japan, the ECB or European Central Bank, the People's Bank of China, and the Bank of England, it is not so large when measured in ratio to each of those economies' GDP as we see here. That's why we believe there is no pressing need for the Fed to shrink its balance sheet through quantitative tightening or reverse QE, as so many seem to believe. We think it would be just fine for the Fed to stay its current size. Note that for this exercise, our ECB total includes the balance sheets of all the European national central banks, the Bank of France, and all the others. Since the Fed is in the final analysis just a bank, we thought you might also like to see the size of the Fed in relation to America's largest commercial banks, JP Morgan, Citibank, Bank of America, and Wells Fargo. It's not as much larger as you might have thought. The Federal Reserve was founded in 1913 expressly for the purpose of being a lender of last resort to troubled banks during a crisis, a task it performed admirably in the GFC and the COVID crisis. But since 1913, it has been burdened with two other daunting responsibilities: to keep inflation low and keep unemployment low. As you might guess, it doesn't really have the capacity to manage either of those, since all it can really do is lend in an emergency and control interest rates. Employment and inflation are far more complicated and far more a function of other things than those. And yet we're solemnly led to believe it has omnipotence as regards both. That's it for this week. Thanks.